Is investing in real estate still a good investment, or has it become too expensive in the Canadian real estate market? Welcome back. My name is Cody. I'm a realtor here in Winnipeg, and in case you missed our last video, we discussed the paradox of renting versus owning in Winnipeg and which one is a better financial decision. And so today we're actually looking at real estate as an investment vehicle to discuss if investing in more traditional methods like stock investing or mutual funds, ETFs, whatever, if you get better returns in those compared to Winnipeg real estate. And honestly, I think you're going to be a little shocked by the results. So I will start off by saying, obviously I have a bias here. I'm a realtor, I love real estate, I invest in Winnipeg real estate as well. And so I do have a bit of a bias towards real estate. However, I do stock investing and mutual funds and other sorts of investments as well on top of my real estate. And I can say in my own personal experience, my real estate has dramatically outperformed my stocks or my mutual funds. However, real estate investing is a lot more of an art than I do think it is an exact science. And so we'll get into that a little bit further on in the video, but I just wanted to clear that up before we get into the details. And keep in mind that as we're comparing these both in terms of achieving financial freedom and allowing you to retire early. That's the whole FIRE movement, financial independence, retire early. So here we go, let's get into it. So stock investing. So in stock investing, typically you're buying shares of a company, and as the company's value goes up, your share of the company goes up with it. Sometimes you get to share in the profits through profit sharing, such as dividends, or there's other various forms that you can invest in stocks through shorting stocks, whatever, etc. I'm not going to get into all the details of how you can invest in stocks, but just generally that's the basic principle of it. Now, this is something that a lot of people experience when they first got into stocks, is that you are so uninformed that you have actually no clue what to buy, and it's a little overwhelming because there's not a lot of guidance without paying a stupid amount of money for software or programs. And in my opinion, the biggest downfall with stocks is that a lot of people will just pick something random, or they pick something that has a lot of hype to it, and they get into that sort of YOLO mindset where they're just picking stocks hoping to get rich really quickly. And then typically those stocks do not perform well, or they are highly volatile. And that could be very scary as someone investing their first time in the stock market, and they typically end up taking a loss on some of their stock investments. So unless you're investing in stocks or you're really trying to learn how the market works, I find that it's best to just invest in index funds or ETFs, because you can buy a conglomerate of stocks called an index fund rather than buying individual ones and trying to day trade because you want to get rich next week. Okay, and that brings us to the most popular index, which is the S&P 500. This is the top 500 companies in North America. And the S&P 500 has actually performed quite well over the past 20 years. It has a 7% compounded annual return. This includes all the dips during COVID and the great run after COVID. And while 7% doesn't seem like that much, it's mainly because you're probably following a lot of internet gurus who tell you can get 20, 30, 50, 100, 2,000% returns in a year if you follow their program. And I don't believe in that. If you want to invest well, it's going to be probably somewhere in the 6 to 12 range of a good return. And using the rule of 72, we could see that if you get a 7% return, it takes approximately 10 years for your money to double during that time. So if you invested $60,000 into the stock market over a 30-year time period, it would double in 10 years, double again in the next 10 years, and double a third time in the last 10 years, meaning that's times 8. After 30 years, you've 8x'd your money, going from $60,000 to $480,000. So now, again, like we did in the rental versus owning, we're gonna take that same amount of money and see what it could get us in the real estate market and what our return would be from that exact same amount of money. Now, I will be honest, the reason I chose $60,000 is because that's a good amount that you would need to buy a rental property that would appreciate well. You can do it with less, and you can obviously invest with stocks with less, but we're talking about a scenario where you're trying to build generational wealth, and not just a scenario where you are day trading $100,000 or $1,000 to build a maybe $10,000, $20,000 portfolio after 10 years. So the $60,000, that gets us about a $250,000 property, and then the extra 10 goes towards your closing costs, your land transfer fees, maybe a couple of repairs you need to make right away. And we're going to be considering the same neighborhoods that we looked at last week, which was the south end of the city, where your rents for a house are going to be a lot higher than they will be for an apartment. And if you remember, our rents were anywhere from $1,700 to $2,000 for an apartment. but that was given it being in an apartment and not a house. So your rent for a house is going to be higher. And so we're gonna say, even in this scenario, we're not gonna consider cash flow. We're gonna say you're just gonna break even because it is a bit of a higher interest rate market. So let's say you buy this house in a high appreciation neighborhood in this current economy, and you break even, meaning it covers all of your expenses plus a couple of rainy day fund dollars for maintenance, repairs, vacancy. So essentially you're cash flowing nothing. All we have working for us is appreciation, loan pay down, and your tax benefits. And I don't want to talk about tax benefits because those are more specific to your personal income. So we're just going to look at the loan pay down and the appreciation. So for the loan pay down, after 30 years, if you're getting a 30-year mortgage, your tenant will have paid off your entire mortgage, which in this case would be 80% of $250,000, which is $200,000. Okay, so you've gotten that $200,000 for free from your initial $60K investment. Now, Winnipeg real estate has gone up 6% per year for the last 20 years. And so if we looked at that appreciation rate, then your property that was worth $250,000 is worth $1.4 million in 2054, which is a staggering number, which is probably not realistic, but what do we know? That's 30 years in the future. So even if we half that and bring it down to 3%, which is a pretty low appreciation rate in terms of the US and Canada, then we're looking at your house price being at $600,000 in 30 years. So in other words, you have gained $350,000 through appreciation, and you have gained $200,000 through loan paydown, which means in total, you've gained about $540,000. You did have an initial $60,000 investment. However, again, this doesn't factor in the fact that your rents will probably go up, meaning your cash flow will eventually be a lot better, contributing towards that initial $60,000 that you invested, probably putting your return closer to $600,000. So that's about 10xing your money, which is a little bit better than the stocks. But the one downside to this is that real estate is not passive. It is inherently more risky because you are dealing with people that might not pay their rent. Your property could have more maintenance issues than you predicted. Stuff could go wrong. And so because it's inherently more risky, the return is also a little bit better. The biggest thing about real estate too is that it is an active investment. Unless you are hiring it out for a property manager, you are the one who's screening tenants, going through applications, getting contractors in to do the work. It is a lot more work than people think. However, I do think that the work is worth it. The juice is worth the squeeze in this scenario because you're getting such a big return. And that was our worst case scenario, was 10xing your money, because you could probably go somewhere in the middle and get to that $900,000 or $1 million mark. And then your investment is way outperforming stocks or mutual funds in our other scenario. And just like our last video, it really does depend on the type of property you buy. And so that's why I think it is important that you get into the right place, and a good realtor can help you along finding that next property. But if you think this still sounds too good to be true and you're a little skeptical of investing in Winnipeg real estate, reach out to me. We can discuss. My contact information is below. But anyways, that's it for today's video. Thanks for tuning in, and I'll look forward to seeing you guys in the next one.